Hello and very warm welcome to Victory IAS. So we were discussing current affairs of last 2-3 years rapid revision, and we have seen this topic is related to entire banking system. Right, in last class we started with banking system, current updates on banking system, and it is a part of that particular topic only. Right, so let's talk about Union Bank of Switzerland. So when we talk about Union Bank of Switzerland, that is Switzerland's biggest bank, recently agreed to purchase Credit Suisse in a move that aimed to contain the panic that ensued after two American banks collapsed earlier. We talked about Silicon Valley Bank also in the last session. This unique acquisition has sent shockwaves throughout the banking industry and has garnered attention from investors and analysts worldwide. Right. So let's understand what are the backdrop or the history of this Union Bank of Switzerland. It was established in 1988 when the Swiss Bank Corporation and the Union Bank of Switzerland merged together. The Swiss Bank Corporation was founded in 1854 as the Basel Bank Corporation by six private bankers in Basel, that is place in Switzerland. It merged with Zurich Bank Corporation and entered into commercial bank sector. Right. This is UBS, that is Universal Bank of Union Bank of Switzerland. Now, what will be the impact of this acquisition? So, the acquisition of Credit Suisse by UBS created a major impact in the banking industry, The Swiss government and regulator broke the deal with UBS paying around 3.2 billion, etc. Those are the details related to merger and acquisition. Now, liberalized remittance scheme funds, right? The remittances that we receive from outside, right? This is from external economy that we receive, that is known as what? Remittances, right? So India's wealthy individuals have invested all their surplus. It is part of balance of payment. It is a part of balance of payment. When we talk about remittances, they are part of balance of payment, right? BOP, when we are interacting with external economy, right? So the India's wealthy individuals have invested all their surplus foreign remittances in various securities over the last few months to comply with the Reserve Bank of India diktat that ended last week, right? So let's see what kind of policy that is there. So in August 22, RBI had directed that any money remitted overseas by Indian residents that remains unutilized for more than 180 days need to be repatriated back to India. So if we are sending some remittances and that remittance is unused for more than 180 days, then that remittances have to be brought back, right? Under LRS, that is this liberalized system introduced in 2004, Indian individuals send money outside up to maximum of $250,000 in a year. Right now, the aim is this simplifies the process of remitting money outside India and encouraging foreign investment by Indian individuals. Now, permissible transaction is related to education, travel, medicine treatment, gifting, investment in shares or property, etc. These are permissible. Non-permissible, as you can see here, trading in foreign exchange or buying lottery tickets. These are not permissible. Available to corporations, partnership firm, Hindu undivided family, and trust, etc. Now, the benefit of this policy will be individuals can diversify their investment and assets and also provide the opportunity to finance their foreign education or travel because they are permitted. But if we talk about the issues related to this policy, then outward remittance can add pressure to the forex reserve of the country, and therefore the government has proposed 20% tax collection at source, that is TCS, for any foreign remittance transaction in financial year 2024. Right now, this clearing corporation, when we talk about clearing corporation, whatever transactions that are happening, so how they are being cleared. So it is about Europe. So the European Securities and Market Authority, that is ESMA, the European Union Financial Market Regulator and Supervisor, has de-recognized 6 Indian central counterparts, that is CCPs, from April 30, 2023. Now, when we talk about CC, there is an organization associated with an exchange to handle the confirmation, right? Confirmation, settlement, and delivery of transaction. That is why it is known as what? Clearing corporation. Clearing corporation is related to exchange to handle, with an exchange to handle the confirmation, settlement and delivery of transaction in a prompt and efficient manner. If we talk about examples of this clearing corporations, then clearing corporations include are the Clearing Corporations of India Limited, that is CCIL, and Indian Clearing Corporation Limited, ICCL, NSE Clearing Limited, right, Multi Commodity Exchange Clearing, right, India International Clearing Corporation, IFSC, and IICC, and NSE IFSC Clearing Corporation Limited. These are Indian examples related to clearing corporation. Now, why this ESMA de-recognized Indian CCs? Why Indian clearing corporations are not recognized? So let's understand this. The decision to de-recognize Indian CCPs came due to no cooperation arrangements between ESMA and Indian regulators. Now, if we talk about Indian regulators, this is Reserve Bank of India, Securities Exchange Board of India, right, and the International Financial Service Centers Authority, that is IFSC. They are not having a clear cooperation, and the impact of this, as per the European Market Infrastructure Regulator, that is EMIR, a CCP is a third country can provide clearing services to European banks only if it is recognized by ESMA. With the withdrawal of recognition of these CCPs, will no longer be able to provide services to clearing members and trading venues established in the European Union, right? So that is related to the geography of that place. Government's stand is ESMA's threat is unreasonable since all clearing corporations are well regulated in India. That is the government stand, right? That is unreasonable threat because clearing corporations are well regulated in India, so other clearing corporations are available. SEBI framework for adopting cloud services. Now, cloud services, as we know, it is related to cloud computing and all. It is not the geographical cloud that we are talking about, so it is related to cloud computing. The SEBI has unveiled a framework for the adoption of cloud services by stock exchange, clearing corporation and other regulated entities, including depositories and stockbrokers, right? Now, if we talk about key points of this particular framework that the SEBI has announced, so it highlights the key risk and mandatory control measures that REs need to put in place before adopting cloud computing. It also sets out the regulatory and legal compliances by all the REs, that is regulated entities, if they adopt such solution. The framework covers governance, risk and compliance, selection of cloud service providers, data ownership and data localization. Data localization, where you are storing this data, right? If the data is being stored in a particular country, then it is known as data localization, right? Where the data is, if data is generated and being stored in the same country, it is known as data localization. Otherwise, if it is being stored in outside the country, foreign country, then the data localization is not there. The document will come into force immediately for all new or proposed cloud onboarding assignments or projects of the REs. Existing REs that are currently using cloud services should comply with the framework within 12 months, right? Now, what is this cloud service we are talking about? So cloud computing is the on-demand availability of computer system resources, especially data storage and computing power. For example, this entire Netflix, Amazon Prime, that data that we fetch, right, that is available for watch the movies, etc., it is all from cloud computing only. So the advantage is the cloud delivers more flexibility and reliability, increased performance and efficiency, and help to lower IT cost that is there. It also improves innovation, allowing faster time to market and incorporate AI, that is artificial intelligence and machine learning use cases into their strategies. It gives the advantage of being ready to scale, ease of deployment, no overhead of maintaining physical infrastructure, etc. If we talk about the concerns here, then the cyber security risk, deployment issues, awareness, etc. In case of cyber attack also it can be harmed. These are the things that is about the cloud computing being deployed by Securities Exchange Board of India, that is SEBI, for financial and capital market. Breaking barriers, building inclusion, right? Now it is about the latest Findex report 2021 by the World Bank. Breaking barriers, building inclusion, right? It is about talking about inclusion. Around 1/3 of adults still lack access to formal financial services, right? Financial inclusion, for example, if we talk about financial inclusion, having bank account, having access to credit, having overdraft facilities, etc., these are financial services. Now, these services are available to everyone in the society or not. So when we talk about economy, now everyone should have access to bank account, everyone should have access to the services that are being provided by the banking system, etc. So that is financial inclusion, that individual or and businesses have access to useful and affordable financial products and services that meet their need. For example, transactions, payments, savings, credit and insurance delivered in a responsible and sustainable way. You can use this to write answers in mains also, right? When we are trying to write answers or answer writing practices, etc., then we need certain definitions also, right? Otherwise you can explain financial inclusion in your words also, but when you are having some good framing of sentences, it helps us in writing answers. Importance of financial inclusion has been identified as the enabler for 7 of the 17 sustainable development goals. If we talk about 17 sustainable development goals adopted by United Nations, adopted by United Nations General Assembly in 2015, and to be achieved by 2030, to be achieved by 2030. Earlier they sustainable development goals, they replaced millennium development goals, replaced 8 millennium development goals, also known as MDGs. So 8 millennium development goals have been replaced by 17 sustainable development goals in 2015 and to be achieved by 2030, right? And there are, for example, if we talk about 17 sustainable development goals, one is zero poverty, second is zero hunger, right? Zero hunger. Third is related to quality health, right? Access to quality health. Fourth is related to this quality education, right? Quality education. Then fifth is related to this empowerment of women and girls, So they are saying that this financial inclusion, all these 17, if we talk about the 13, climate action, 13 is related to climate action. If we talk about 14 is related to protecting life under water, that is protecting marine biodiversity, protecting marine biodiversity, If we talk about 15 is related to protecting land biodiversity, right? So these are 17 sustainable development goals. Few of them I have just discussed. So there are 17, and out of 17, 7 sustainable development goals get enabled through financial inclusion. So that shows the importance of financial inclusion. In G20, the G20 committed to advancing financial inclusion worldwide and reaffirmed its commitment to implement the G20 high level principles for digital financial inclusion. The World Bank Group, as we have seen at some point of time, that the World Bank, IBRD and IDA, International Bank for Reconstruction and Development, and International Development Agency, that is IDA and IBRD combined together, known as World Bank. But World Bank has 5 agencies also, MEGA, etc. is also there, right? So 5 agencies are there. Consider financial inclusion a key enabler to reduce extreme poverty and boost shared prosperity, right? That is the view of World Bank. Financial inclusion has been linked to up to 14% growth in the gross domestic product in developing economies. Now, what are the challenges in achieving financial inclusion? So, lack of access to basic infrastructure. If bank branches are not available, if banking services are not available in remote areas, rural areas, then we cannot achieve financial inclusion. Low financial literacy. People are not having literacy or knowledge about the banking system and the banking products. Limited trust in formal financial institution. For example, if people are able to see that their deposited money, sometimes when bank lend those deposited money as loan, and those loans are defaulted, then there are certain conditions being put by banks to withdraw money also. So that that also push people back to trust in the banking system, and that is one challenge we are having with respect to financial inclusion. Insufficient regulatory framework sometimes, but now we have seen the powers of RBI has increased, and RBI is exercising its supervising role, its monitoring role, etc. So now we are having this insufficient regulatory framework. We cannot say like this to a great extent, but yes, sometimes loopholes are there and banks are taking advantage of it. High transaction cost, for example, now minimum balance, etc. So those are the things which can be the barrier for to achieve financial inclusion. Lack of diversity in financial services, right? Limited services are there, so that kind of thing. How India's G20 presidency help in improving financial inclusion? So the theme of India's G20 presidency was Vasudev Kutumbakam, that is underlines the message of equitable growth and shared future for all. Shared future for all. The G20 Global Partnership for Financial Inclusion working group met under the groupings for Global Partnership for Financial Inclusion Initiative. The G20 Financial Inclusion Action Plan aims to prevent future economic crisis by encouraging conditions that promotes its objective of financial inclusion and stability. Now, four major drivers highlighted in the G20 to lay the groundwork for further progress towards financial inclusion. The acceptance of 2030 agenda for sustainable development as a worldwide framework for sustainable development. This is number one. As we have already seen, these 17 sustainable development goals have to be achieved by 2030. Rapid development and penetration of digital breakthroughs. Third is greater emphasis on the underprivileged population, and fourth is mainstreaming financial inclusion. More focus, more policy should be there in this particular regard, right? Now, financial inclusion scheme in India, the first scheme very popular is Jan Dhan Yojana, right, where you can open zero balance account, right? Pradhan Mantri Jan Dhan Yojana, Atal Pension Yojana, Pradhan Mantri Vaya Vandana Yojana related to financial inclusion, Stand Up India scheme, Pradhan Mantri Mudra Yojana, right, refinancing, etc., giving loans to this Kishore, Tarun, etc. This Pradhan Mantri Suraksha Bima Yojana for insurance, this Sukanya Samriddhi Yojana, Jeevan Suraksha Bandhan Yojana, Credit Enhancement Guarantee Scheme for scheduled caste. These are financial inclusion related schemes of Government of India. You can use this when you are writing essays also, or when you are writing mains answer in economies, or so for example on social justice also, then you can use these schemes. Venture Capital Fund for scheduled castes under social sector initiative, and Varishtha Pension Bima Yojana. These are the schemes related to financial inclusion, right, to achieve financial inclusion. Now, Securities Exchange Board of India, regulator, as we know, this is regulator and capital market, stock market, right? So SEBI has increased its authority in the appointment of directors to stock exchange and clearing corporation. Just now we have seen what is clearing corporation. Now let's understand the rules related to appointment of director. SEBI can now appoint 3 public interest directors to the board without requiring shareholders' approval. So, shareholder approval is not required. Exchange and CCs are required to follow a Chinese wall policy to separate functions and appoint a chief risk officer to mitigate risk. So, there should be clear mandate and that should not be having any overlap. So, separate entity going for these works, right? So, when we talk about this public interest directors, what are public interest directors? They are responsible for safeguarding the public interest and have a tenure of 3 years. PIDs will have regular oversight over issues such as governance, standards and technology. So they are basically one function among many. The SEBI is having one of the function, very important function is to safeguard the investors' interest, right? To safeguard investors' interest. So that is for that purpose the Chinese wall policy they are going for. What is Chinese wall policy? Having clear mandate and demarcation between the authorities. It is a virtual information barrier erected between those having insider information about the company and those who do not, in order to prevent misuse of inside information in securities transaction that we have seen, securities transaction or securities trading. A clearing house is a financial, that is what we have seen already, right? Clearing house is a financial institution formed to facilitate the exchange of payment, securities or derivative transaction. The SEBI, that is non-statutory, established as a non-statutory body in 1988, but as I have already told you that now statutory body is the regulatory, non-statutory body is the regulatory body for the securities and commodities market in India under the ownership of Ministry of Finance. It was earlier, but in 1992, in 1992 it was given the status of statutory body, right? Because of a lot of issues, fraudulent activities and all, so it was given the status of a statutory body, and now it is an autonomous body, right? Now it is an autonomous body. So this is related to financial this is related to all this digit banking, etc. Now let's talk about the banks which are too big to fail. Too big to fail banks. What are too big to fail banks, and what makes Indian banks safe? This is what we have to understand, right? For example, ICICI, State Bank of India, they are referred as the banks which are too big to fail. If they fail, the entire economy may collapse, right? So it is not possible that these banks fail. If these banks fail, then entire economy may collapse. Recent banking crisis in the US has raised the question of how secure Indian banks are in the age of startups and digitization. For example, we talked about Silicon Valley Bank, right? Silicon Valley Bank, which defaulted on their deposits. The kind of condition where we discussed bank run condition happened there. Despite the recent bank failures in the US, that is Silicon Valley Bank, which occurred more than a decade and a half after 2008 global financial crisis, Indian banks remain unaffected, right? India has established domestic systematically important bank, also known as DSIBs, also commonly known as too big to fail banks, to protect itself from 2008 or Silicon Valley Bank like episodes, right? What are too big to fail banks? So what are these banks, right? So, and how they are being selected, and what are their significance? So a bank that might substantially disrupt the financial system because of its size, lack of substitutability and interconnectedness in the event of its failure, right? So this is related to what are DSBs, right? DSIBs, right? Or too big to fail. Simply we can say the banks which are too big to fail. Now how they are selected? So the RBI follows a two-step process for this, right? First, a sample of banks to be assessed for their systematic importance, systematic importance, and that is decided, right? And what is the significance? The failure of a large bank anywhere can have a contagion effect around the world, as we have seen in 2008 subprime crisis also. The world was facing liquidity crunch, right? But India got little less affected because we were not having lot of foreign debt or foreign investments at that point of time. In 2010, Switzerland-based Financial Stability Board, that is SFB, decided for example, if we talk about the significance, the failure of a bank damages confidence in the entire banking system. So this is also one of the things. So when we talk about a Switzerland-based Financial Stability Board, they recommended that all member countries should put in place a framework to reduce risk attribute to systematically important financial institution, that is known as SFIs, in their jurisdiction, right? In their jurisdiction. So this is about the DSIBs, or the banks which are too big to fail. Now bank system based on Basel effects, the third leverage ratio domestic global exposure economy, due to measures having a size beyond 2%, interconnectedness of GDP will be financial selected in the system, right? So that we need to keep in mind, that the banks are having contagion effect, because bank sometimes they borrow from another bank and they put their deposits in another bank, and the securities, the kind of bonds, etc., they also get traveled, right? So the DSIB's framework was announced by the Reserve Bank of India in 2014. Next step to ensure that what kind of steps will be taken. So the next government DSIBs or DSIBs. Next, the DSIBs segregated buckets based on their systematic, right? Based on their systemic many has importance, like ICICI scores, HDFC scores, etc. RBI classified SBI Bank and this HDFC, ICICI as DSIBs, right? Jurisdiction to guarantee financial stability, that is there. And So these are related to the kind of too big to fail banks. So these are known as what? Too big to fail. And how Indian banking system is unique. So sound regulatory practices and government intervention when banks have faced difficulties. That is related to Yes Bank. When Yes Bank was facing difficulty, so it got merged with some big bank, and then the kind of regulatory process got strengthened and the condition of bank also enhanced, right? Different balance sheet structures, household saving constitute a major part of bank deposits in India, which can't be withdrawn in bulk quantities, right? So a large chunk of Indian deposits is with public sector bank and with very strong private sector lenders such as SDFC, ICICI or Axis Bank. So in these condition, these banks are having some uniqueness. The RBI's guideline for 2018 advising banks to create an investment fluctuation reserve in just the kind of counter cyclical tool that has relatively insulated Indian lenders from interest rate risk, right? So this is how still the RBI must remain on guard to ensure neither global contagion nor management missteps threaten any local lender. So it is about the banking system. Now Irida, so from here we will discuss in the next class. So thank you very much to watch this video on the platform of Victory IAS. We'll meet in the next class to discuss more on current affairs. Thank you very much. Take care. Bye bye.